Hi, my name's Josh Mahony, Chief Market Analyst at Scope Markets. Let's look ahead to Friday's Eurozone inflation report, rounding off a week that's going to be dominated by inflation data out of the region, with the likes of France, Spain, and Germany all reporting their numbers before that big, wider regional number on Friday morning. And this will really be a potential market mover. It comes off the back of a Monday that saw commentary from both the chief economist from the ECB, Lane, and Villeroy, who is a French ECB economist, both coming out and essentially saying that they think we're going to see a June rate cut. Looking beyond that, Villeroy actually said that he thought July shouldn't be written off for a second rate cut, and that certainly flies in the face of some of the commentary we've been seeing elsewhere. So certainly some confidence from the ECB that we will see a rate cut just a week after this inflation data. And so this serves not only a precursor to that ECB meeting, but also as a warning or a reason for encouragement, depending on how the numbers go, over the potential for a July rate cut as well. Let's get into some of the charts and the data. First and foremost, I wanted to show you the outlook in terms of expectations for some of these numbers. We can see on Wednesday, we're expecting to see the German numbers coming out. First and foremost, prior to this number, this is 1 p.m. UK time, you're going to see regional numbers as well. So look out for those regional numbers. They will give you that first early insight into the region. Then you see the German numbers, expectation for 2.5 on the year-on-year number, but 0.2 on the month-on-month. And this really highlights the trend that we're likely to see this time around, which is essentially higher year-on-year due to base effects and lower month-on-month. Personally, I'm encouraged by the month-on-month. We see a 0.2, then that's back towards the kind of level we need to get back to target. And it's the same kind of thing expected across the board. You can see Spanish inflation expected at 3.5, but 0.2 on the month. French inflation, 0.2 on the month, but ticking upwards to 2.4%. And then the main Eurozone number coming out at 10 a.m. UK time, expected to move upwards to 2.5%, same as the core reading, but that is moving downwards with a continuation of that gradual downtrend. The monthly reading expected is 0.1, which would be encouraging in my mind. But certainly this really highlights the somewhat difficult tightrope being sort of walked by the markets, where they have on one side the likely headlines around the uptick in terms of inflation, which would be likely to come at the detriment of equity markets and potentially upside for the euro. But at the same time, the monthly figures are actually showing encouragement after a 3-month period where we did see significant upside in terms of those monthly readings, which really set back the likeliness of a return to 2% this year. And certainly the European Commission came out with their latest outlook for inflation. They saw inflation at 2.5 this year, with a return to 2.1 next year. So they think they're going to get there or thereabouts next year, but we aren't close to inflation, close to the target. You can see 2.5% expected, but that's the thing. I think we're likely to see an uptick. Here is the issue, right? The ECB isn't only making a decision for a single entity; it is making a decision for a region. You can see here that at the top end of these lines, we have Spain, 3.3% inflation. At the bottom end, we've got Italy at 0.8% inflation. And so there's a wide disparity when it comes to inflation experiences within the region. And I guess the fact of the matter is that they're close enough to feel that they can cut interest rates because of the commentary that we've seen from those two ECB members on Monday. Here's the breakdown in terms of the inflation data as it is, 2.37 or 2.4, as you'll see on the economic calendars. But the reason why we're likely to see that uptick this time around lies in those base effects. You can see last time around in May, 0.02 was the monthly reading. That's what's been replaced. So even if we see, as we're expecting to see for that Eurozone number, a reading of 0.1, which would make a very welcome break from the figures we've seen recently. As you can see, the April figure came in at 0.6 essentially, or 0.58. Even if we did see 0.1, that's still enough to drive inflation higher to 2.5. So what happens if we don't see 0.1? If we see a figure higher than that? Well, that would see a greater increase in terms of that headline number. So, that is worth noting. We're essentially replacing a flat number for last year. And so everything that gets put on this month is going to come onto that year on year. And we do have the possibility of seeing a bit of a market concern, essentially, if we do see a significant uptick in terms of inflation. At the bottom end, you can see the effect of those recent monthly figures. I've provided a 3-month annualized, which is probably going to be about the starkest way of showing this. But essentially, the last 3 months were the particularly concerning ones. Prior to that, we did see both in November and in January negative readings. So, this is certainly just trying to highlight exactly how bad it has been recently. But certainly, the trajectory over the past 3 months put us on an 8%, 8.13% annual reading. Obviously, we're not, or we don't look likely to continue on that recent trajectory. But the last 3 months have essentially totaled near enough 2% by themselves. So it's going to be very difficult until we strip out the 3 months that have just been. It's going to be very difficult to get back down to target this year. Doesn't seem likely at all, quite frankly. And, the question mark is then, are the ECB willing to act irrespective of that? And it appears to be so. Similar kind of picture here in terms of the core reading. You can see that March figure, 1.1%. Concerning. If you cast your mind back to where we were previously, you can see a similar kind of picture last year. You can see that April figure, 0.98. I haven't updated this actually. You can see that we're stripping out the May figure this time around, but it is relatively low down there. And so, ultimately we're looking at a significant risk that soon enough we essentially stop the disinflationary pathway that has been very consistent thus far. So 0.233 is the figure that we're replacing this time around. But if you look at the previous figures, 0.7, 1.1, and 0.67 are the numbers for the past 3 months. So we need to see that month on month drop down in a very meaningful manner. Markets are expecting that, but the disinflation, like I said, the disinflationary pathway that we've been seeing, grown accustomed to, is likely to end soon. Because if you look back to the prior year, that period where we're seeing very significant numbers stripped out is essentially over now. And now the comparatives, the base effects, become a lot more difficult for us to essentially keep up with, to maintain that disinflation. So we're in the mid twos. We're expected to get back down to 2.5. But there's concern that soon enough we're probably going to end that and just remain in the mid 2%, much like what's happening in terms of that headline figure. In terms of market expectations, we have now a 91% chance of a rate cut for the June meeting. The next one would then likely be in September, as markets have 55% attributed to that September meeting. Well, to then add another 25 basis point cut on from that. And then at the back end of the year, we also have a potential chance, around about a 41% chance of another rate cut in December. So markets are feeling very positive about what's happening in terms of the Eurozone and in terms of monetary policy and the possibility of rate cuts. And that has provided upside in terms of equity markets. The DAX moving back towards record highs. Let's just get the DAX up. So you can see here the pullback seen on Friday, taking us back into what was previously the record high here at 185.67. That's now represented support, with the ECB comments coming out on Monday, providing a nice upside move for the DAX. 188.91 is the record high that we're looking for now. I wouldn't be surprised to see us moving upwards as we move throughout the week. But bear in mind, I think generally markets take the year-on-year figure as the most important, and that's what is likely to grab the headlines. And so an upside move in terms of inflation is probably going to be a little bit concerning. The caveat to that is that's what's expected by the markets. And we've seen commentary from 2 prominent ECB members who are both very confident that we are on the cusp of a rate cut. So I don't necessarily think this is going to completely derail the DAX. And so the bullish trend that has been playing out over the last year and a half, something like that. Sorry, about the last 9 months now, sorry. does point towards the likeliness of further upside to come into play from here onward. Certainly a breakup through that prior resistance level at 188.91 would provide the potential breakout play. Until then, yes, we could retrace further, but doesn't look that likely, quite frankly. If we're looking at the hourly time frame, you can see here this trend of lower highs now coming to an end with us rallying up into this 187.66. So certainly a move through that level gives us greater confidence that even if we do see a near-term pullback, let's say a pullback into this area, that might be a precursor to us moving higher once again. And we'd need to see a breakdown through this prior low that we've just recently set of 185.15 to point towards a wider retracement coming into play for this market. Another market worth watching out for is Euro Yen. In part just because of the trend that has been in play, but certainly the possibility of perhaps a little bit of concern around a stronger year-on-year figure could provide further upside for this market. As you can see, it's moving higher as we speak. But certainly there should be some concern, not necessarily concern, but there should definitely be measures taken to protect yourself against any possible BOJ intervention. That is, of course, the risk of trading any yen pairs at the moment, because, of course, we did see this sharp move previously. And so stop losses are very important for this market. We are trying to regain that lost ground. And you can see the prior peak was around about the 171.5. Whether we're going to get back up to that remains to be seen. But for the near term, the trend is bullish for this market, as most are against the Japanese yen. And in particular, if we see stronger inflation data, that could provide further upside for this pair. Finally, another one worth noting is euro sterling. Bear in mind that the UK is expected to cut rates in either September or November. There's a good chance that we only see the Bank of England cut perhaps once this year, maximum two. So less expected from the Bank of England, and that has provided downside in terms of this currency pair. It's taken us back into this support zone of essentially 0.85. You can see a number of different lows being established over the last year. And that gives us a question of, do we continue this recent downward trajectory, or do we see a bit of a pop for this market? Well, in terms of the near-term trajectory, you can see here we've regained some ground following that decline into support. Starting to see a bit of selling pressure coming into play here, but you'd really want to see a break up through these resistance levels, 852 and 853, essentially, to start signaling a potential bottom for this market. And until that happens, there's a possibility that we're just essentially retracing within this bearish move that has been playing out recently. So a cluster of Fibonacci's up ahead for this market to contend with. And certainly, if we were to see significant downside in terms of inflation or lower numbers than expected, then that could provide some weakness for this market. But I think there's a possibility that we do see markets concerned around this inflation data because of the fact that we're essentially not going to get back to target. But like I said, it's a tightrope for this one, because essentially we've also got the ECB members coming out in a dovish mood, and that negates, for the most part, the fact that inflation at the moment looks likely to remain above that 2% target for the entirety of this year. In terms of this market, it's a key one because we're essentially at a crossroads. We're at a really key support level. A breakdown through that support level would take us into the lowest levels since sort of the third quarter of 2022. So, that could either set us on the pathway of another significant decline, or we return towards the upside once again. And certainly the ability to break through either support or resistance is going to tell us a lot about that. And by and large, I think given the inflation data that's coming out over the course of this week, we should probably gain a lot more understanding of where this market's going to go in a week's time. So plenty to sink our teeth into. It's going to be an interesting one because of the fact that we have got inflation data released over the course of the week, culminating in Friday's big Eurozone reading. And, for the likes of the DAX, will we just focus on the fact that we've seen ECB members coming out and saying that they're going to see rate cuts coming into play in the coming week? Or will people just become fearful because they've seen an uptick in terms of that year-on-year inflation figure? plenty to sink our teeth into and keep your eyes out for. I hope this has been useful. Plenty more to come from me. Make sure to subscribe and click that like button if this has been useful. Have a great day, guys.